For most people, a recession is a time of despair, struggle, and financial hardship. But for some people that know better, a recession is a great opportunity to get rich. Take a look at some of the well-known personalities in the YouTube finance space. Stephan, Brandon Turner from Bigger Pockets, these guys changed the trajectory of their life by making investments when assets were at all-time low prices during the aftermath of the 2008 recession. They deployed their money into investments at the same time that most people were either panicking or not paying enough attention to the opportunity at hand.
But now it's official, we are in a recession.
Now, for most of you, you were probably too young in 2008 to take advantage of discounted assets. Your parents probably experienced a shock to their finances and were trying their best to budget their finances and make ends meet. Meanwhile, you were in the other room doing this. So now that you're older and your priorities have switched from getting a new high score on Just Dance to making money and planning your future, I thought it'd be a good idea, given the state of the economy, to talk about how we can invest our money and take advantage of this upcoming recession so that you can come out on the other side better off than when you went in. But before we get into that, make sure you like the video and subscribe to my channel for more videos just like this one. It would really help my small channel grow. Before we get into how to profit from a recession, first I want to discuss the question of just how likely is it that the US economy actually falls into recession in the year 2023. I'm sure you're aware that there have been constant talks of an impending recession all over the media, and it seems like it's been that way ever since the last recession that happened in 2020. You've probably gotten exhausted from hearing about whether or not we are indeed falling into a recession, so I want to clear things up by first talking about a leading economic indicator that investors and economists look at that has historically predicted recessions with a pretty astonishing amount of accuracy. And I think it's important to talk about this indicator, because after you've learned about this indicator, not only will you be able to have a gauge on whether a recession will occur in 2023, but for the rest of your life, you'll be able to monitor this indicator and have the ability to predict and plan for recessions that are bound to happen in the future. And by doing this, you'll no longer need to rely on finance YouTubers that claim that a new recession just started this week, and the week before that, and the week before that one. And actually, according to finance YouTubers, there's been a new recession every week since 2018, and we should probably do this now to prepare. Anyways, the recession indicator I'm talking about is the 10-2-year Treasury yield curve. I promise you don't have to be a financial genius to understand this graph, but it is a little more complicated than most things, so please bear with me whilst I try to break it down as simply as I can for you guys, so that you can understand how this tool is used to predict recessions. First of all, what is a yield curve? The yield curve shows the difference between short-term bond returns and long-term bond returns. In the case of the 10-2-year yield curve, the graph is showing the spread in the interest rate you get when investing into a 10-year Treasury bond compared to investing in a 2-year Treasury bond. Most of the time, the yield curve will be greater than zero, and that tells us that we're in a normal, healthy economy. However, sometimes the yield curve actually drops below zero, and when that happens, we say that the yield curve has inverted, and that means that shorter-term bonds are actually yielding a higher interest rate than long-term bonds. And this is a big warning signal to us as investors, because generally speaking, the longer the duration of the bond, the higher the interest rate you should expect to have. Because with longer bonds, you're lending your money out for a longer term, so there is more of a risk of things going badly in the economy. So since there's more risk involved, you would expect to be compensated for that risk with a higher interest rate. But in the case when the yield curve is inverted, the shorter 2-year bond is yielding a greater interest rate than the longer 10-year bond, meaning that investors are less confident in economic conditions over the next 2 years and believe it's more risky to lend their money during these next 2 years than it is to lend their money over the next 10 years. And economists use this yield curve as a possible signal of a recession, since history has shown us that when the line on this graph inverts, a recession is very likely to happen in the next 18 months. But just how accurate is this indicator in predicting recessions? Well, a sustained inversion of the 10-2 yield curve has proved to be so reliable in predicting pending recessions that it has correctly predicted every recession for the last 50 years. And notice how I said sustained inversion, because in June of 1998, the yield curve actually did invert, but a recession didn't occur within 18 months. But as you can see, the inversion was ever so slight and brief. It was not a sustained inversion of the 10-2 yield curve, so clearly how much and how long the yield curve inverts plays a factor in how likely a recession is to occur. And this is bad news for us, because right now, the yield curve has now been inverted for many months already. And what's crazy is that the current spread between the 10-year yield and the 2-year yield is around minus 70 basis points, which is greater than what we experienced before the dot-com bubble and the global financial crisis in 2008. In fact, it's the deepest the inversion has been since 1981. So what we can take away from where the yield curve is at currently is that if history repeats itself, then the US economy will enter a recession somewhere in 2023 or 2024. So what can we do to prepare and profit from this potential recession? Because although a recession is generally a time of financial hardship, for the people that are prepared to take advantage of it, it is one of the greatest opportunities to build wealth. And as Warren Buffett says,
when stocks are down, we're going to be buying on balance, and who wouldn't rather buy it, at a lower price at a higher price? People are really strange on that.
That's right. The reason why a recession is a great time to build wealth is because assets are cheaper. Our economy is cyclical in nature. It expands when times are good, reaches a peak, and then contracts in times of recession and reaches a low. And assets follow the same oscillating cycle. When the economy is expanding, people have more money. They spend more, they buy commodities, real estate, stocks, and the prices of these assets increase, which makes them money. Eventually, in the market cycle, you reach peak euphoria. This is when people like to say that your barber will start to give you stock recommendations, but I think it's more appropriate for our time to say that this is the time when your favorite influencer will start shilling you their own NFT collections, and 13-year-old kids will start making TikToks about the next altcoin that's going to 100x in price. At this point, the prices of most assets begin to drop in price. The majority of people get burned, and optimism in the markets hit an all-time low. But this is the best time to invest your money, because prices of assets or investments are selling for a discount. Now you might be wondering, what investments should I buy at a time like this? My best advice for this is to stick to proven wealth creation assets. These are assets like stocks and real estate that have consistently created wealth for millions of people for a long time. You generally don't lose money in these asset classes as long as you are diversified and continue to hold for the long term, not selling when the market is down. I would avoid any investments that are trendy. You can get lucky on those trendy investments, but more than likely you will lose. And if you're wondering about what a trendy investment might look like, cue Andre Geek promoting BlockFi.
If you're not familiar with BlockFi, it's one of my favorite places to keep my crypto online because they pay me up to 8.6% annual interest compounded monthly, which is crazy. And I know that number is ridiculously high. It sounds like BitConnect or like a pyramid scheme, but I promise it's not. It's a very legit company with very So going forward, I'm going to remove all of my BlockFi links and I will not include them, and I strongly urge anyone that has their money either on BlockFi or FTX to please move it offline.
So yeah, avoid anything like that. Anything that seems too good to be true and has not stood the test of time. For the average investor, stocks usually make the most sense, since you can make great investments in the stock market without needing a deep skill set or a lot of time on your hands. Also, stocks are especially a good buy during a recession, since stocks are a fairly volatile asset class, meaning that when they do come down in price, they decrease a lot more in price than other type of assets like real estate and bonds, so you buy them at a steeper discount. This creates a huge wealth building opportunity. In fact, if you bought stocks during every bear market since World War II, on the day the S&P 500 closed in bear market territory, you would have averaged a total return of 22.7% over the next 12 months, which is over double the historical average return of the stock market. But how you buy stocks is also important. I feel like I might have given you guys the impression that you should wait until stocks crash before you swoop in and buy them at a discount. But believe it or not, you shouldn't be waiting it out to see if stocks fall further before deploying all of your savings into stocks. This is a practice known as timing the market. And timing the market is not an effective strategy for investing, because it's impossible to time the market correctly on a consistent basis over long periods of time. What usually happens is you end up investing all of your money too soon, and the market continues to drop further and further, resulting in you losing more money. Another way timing the market can go wrong is when the market doesn't drop as much as you thought it was going to, so you never end up actually investing any money at all. And when the stock market recovers, you don't have any money invested, so you lose out on those gains. I actually ran my own experiment in Excel to try and prove this point and made a video about it. I analyzed over 7,000 days of historical stock market data to find out if trying to time the stock market dip is an effective way to invest. I created all of these different timing the market investing scenarios, and what I found was that for all of the scenarios I created, trying to time the market was not as effective of an investment approach as simply dollar cost averaging into the stock market. Dollar cost averaging, if you're not aware, is basically the opposite of trying to time the lowest point of the stock market crash. What you do is you invest a small portion of money on a consistent basis regardless of what happens to the market. For example, it's common for people to set up a recurring investment in which every time they're paid by their employer, a percentage of their paycheck is automatically invested into their retirement account. So with dollar cost averaging, you're not hoarding cash and trying to guess the market lows like when you're timing the market. Instead, you are consistently investing money into the market, whether the market goes up, down, it doesn't matter. So if you're wondering if it is a smart idea to be investing your money right now when the stock market is down around 16% year to date, well, the data says that it is. Right now, I'm dollar cost averaging into a stock market index fund, which is basically a huge basket of stocks that provides me with great diversification into the stock market. I have my stock brokerage set up to invest a little bit of money every day automatically, and that way I don't need to remember to go into my app and buy stocks every day. I think one of the most important things to consider when trying to profit from a recession is that you're going to need money to make money. During a recession, companies lay off their workers as they anticipate lower earnings, resulting in higher unemployment. You don't want to be in the unfortunate position where you've been laid off and now you don't have the funds needed to continue dollar cost averaging into the stock market, right at the time when the stock market is at its lowest point, when it's the best time to be buying. So I think it's important to do whatever you have to do to keep your income up, whether that means making efforts to remain employed or finding a secondary income source like starting a side hustle. And as always, before you invest anything, make sure you don't have any high interest debt and have an emergency fund already saved up. Assuming you've taken care of those two things, I would be trying to invest as much as I possibly can in the stock market to take advantage of these lower prices that are inevitable during this next recession. When you do invest, make sure you hold your investments for a long period of time. And if you do that, you're going to maximize your profits over these next few years, which are probably going to be a tough time for most people. But that's it for today. I hope you guys enjoyed the video. Thank you for all of your support, and I will see you guys in the next one. Take care.